Hello, everybody, and welcome to today's webinar. I'm Rachel Neighbors.
Jeff Neighbors here.
And we're really glad to have you. As we get started, just let us know, can you see us? Can you hear us? There should be right on the side of the screen a little chat feed thing. Just let us know, yes, you can see us, and yes, you can hear us. Sometimes there's a bit of a delay.
For your voice
All right.
to get through the interwebs.
Yes.
Thanks, Rami. Okay, Doreen, all good in living color.
You know it.
Loud and clear. All right, great. Hey, guys and gals, on the bottom here, here at the beginning, I'd like you to check out the polls section. And there's a poll. Have you invested in real estate before? Always interesting to see what kind of group we have with a presentation like this. Hey, Willie. Thank you, Scott, Russ. And if you want to chime in with, where you're coming in from, as the poll is rolling in, it's always also nice to see, where this event is spreading far and wide in the days of everything being so virtual.
Yeah.
I feel like for the last 15 years, all of the technological adoption that we've been doing was in preparation for this.
Oh, I thought you were going to say that the last 5 months feels like it's been 15 years long, because it also feels that way, I think.
Also that. All right. Rami from Orange County, Colorado Springs, coming in from, are you inside NORAD with a really fast internet connection? From Tom. Hey, Tom. All right. A Gibson. All right. Tri-Cities, Washington from Scott. And remember to hit that poll. Let us know. Have you invested in real estate before? Dark side of California from Philippe. Hey, Philippe. Good to see you. San Diego County from Willie. Boston. Single family ranch houses. 20 miles north. Okay, great. Let's check in on the poll. All right, 88.9% of you have invested in real estate. We're going to close the poll. Okay, look, we got 2 people from Orange County today, or at least. We've got Rosna as well. And
hey, Russ.
Yeah, from Hawaii. Did I pronounce that right?
I don't know if you did that right, but it was close.
You know how to do it, right?
I don't know how to do it.
Yes, you do. Every time you say it, it's
Kailua, Hawaii. I think that's the
Hawaii
is the correct way to say it.
Yes.
That's what I've learned.
Okay.
All right, Columbus. Yeah, C-Bus represent. What's up, Dale? All right, well, let's go ahead and jump into our next. We're going to do the next question first, or are we going to get right into our presentation?
We're going to get going, and I'm going to hide the votes. Looks like the yeses are overwhelming here, that you have invested in real estate. So that's great. That's what we find is usually when somebody wants to invest their solo 401k in real estate, it's because they have a little bit of experience doing it outside of their solo 401k. So this is going to be great for you. And if you're one of the 2 people that has not invested in real estate before, I hope this is very educational. So we're going to close the poll. Thanks for participating in that. We'll have a couple questions again for you later. And hello to Jennifer in ATL. All right. Now we're going to turn the chat off for a second. If you have any questions, instead of using the chat on the right side, use the ask a question thing on the bottom. And we'll probably queue all those questions up for after the presentation. So there we are. All right. Now we're going to share the screen and get rocking. All right. Now you should be able to see the screen, and we'll get going. Just pop something in the questions box saying you can't hear or see if you have any problems. Otherwise, we'll just be rolling on through.
All right. So, as you know, today's presentation is all about 5 ways to invest your solo 401k in real estate. And of course, as we get started, even though we're going to be talking about investing, none of this information is investment advice. It's not tax advice. It's not legal advice. It's always important to do your due diligence. Make sure you're vetting these deals before you are investing, especially before you're investing your retirement funds. So let's get right into it. Real estate has been probably the most popular alternative asset for self-directed investors since the 1980s. And self-directed investors love real estate because it's a tangible asset. It produces yield, that is cash flow. It's an appreciating asset.
Bless
Excuse
you.
me, not Corona. And can protect against inflation. The solo 401k is a great vehicle for holding real estate, and many of you already do. For those of our seasoned real estate investors here on the webinar today, I hope you will learn some new ways that you can explore real estate investing with your solo 401k. And if you're brand new to investing in real estate, then this is going to have a lot of information that will be great for you.
Okay, so before we get into the 5 ways to buy real estate in your solo 401k, I just want to check in and ask another question. If you click over there in the polls, obviously this audience is vast majority experienced real estate investors at some level. So the next question in the poll is, have you invested in real estate with your solo 401k yet? Go ahead and take a moment to take the poll. And as the answers come in, we will collect them, we'll announce them. They're coming in live. You get the yeses and the nos, neck and neck. I feel like we should have one of those auction guys.
Yeah. Hey, and the yeses are coming in.
Yeah.
No's.
Oh, the yes is in the lead. Now the no's coming up. The no's coming in for the lead. We got is neck and neck, 50-50. The no's are winning it, and the yes is coming back. Oh my goodness. The yes hit the nitro button.
Is this like a secret skill that you have? I've never heard you do this before, but you're actually pretty good at it.
I can just see like an auction, like Barrett Jackson, the guys run
Yeah.
around, and then you walk out of stage left with a wireless mic, just like, excuse me, sir, I have a question for, no, stop a minute. Okay, it looks like the activity has settled in, and now we have 44% are yes, I've invested in real estate with my solo 401k, just up to 46, and 54% have not. So we're going to go ahead and close the poll. So what I'm taking from this, Rachel, is that we have an audience of mostly people who have experience with real estate investing, but about half of the people who have experience with real estate investing have not yet done it in the 401k.
Yeah.
So if you're one of those that said no, this is going to be very informative for you. And if you're one of those that said yes, pay close attention and see what new things you learn about these 5 ways. So I'm going to close the poll and we'll continue on.
So our first way to invest in real estate with a solo 401k is to buy a property direct with cash. Buying a piece of real estate with cash means you don't need to use leverage. You don't need financing.
And one thing that I noticed some people say is they tend to use the word cash sometimes to mean non-retirement funds. And this is actually a misnomer. This is something that sometimes financial advisors will say to simply indicate that their retirement plans don't allow for alternative investments. The structure is the real estate plan, or the retirement plan, the retirement account, and the asset. You can have cash inside a retirement plan. In fact, you should, especially with real estate. We'll talk about that later. But I just want to make clear when we're getting into this, we're talking about buying property inside your solo 401k with the cash that's inside your solo 401k.
That's a really good distinction. So using the cash that you already have in your retirement plan to close on the property because you don't need to then get a mortgage. So awesome. Let's walk through an example. David lives in Columbus, Ohio, and he has about $450,000 in his solo 401k. The cash flow rental market in Columbus is strong and growing. And David identifies a property he'd like his solo 401k to purchase. The property's listed at $120,000. And because David has plenty in his solo 401k, he decides to purchase the property with cash. He doesn't need to get a mortgage.
Right. So here he goes through and he analyzes the numbers. There's a property that should rent for $1,300 a month. He looks at the expenses of the property management fee, taxes and insurance, a budget for vacancy, capital expenditures like replacing the roof every 20 or 30 years. Utilities are going to be paid by the tenant, so nothing there. And then a budget reasonable for this amount of a property for maintenance and repairs. So you can see that there on the screen, expenses of $587. So he runs the numbers and finds that his net operating income will be about $8,500 a year. His monthly cash flow, especially with no mortgage payment, is going to be $712 a month. That's $1,300 a month gross, and then the $587 in expenses. His cash on cash return is 7.12. He expects that this property in this area will, conservatively speaking, appreciate by 2.75% per year. And so his 5-year pro forma annualized return is a total of 8.78%, secured by tangible real property.
David's solo 401k trust is called Jones Investment Trust. As the solo 401k trustee for Jones Investment Trust, David contacts the realtor and makes an offer for $120,000, the listed price. The offer is accepted, and David sends $2,500 in earnest money from Jones Investment Trust and his solo 401k bank account to the escrow company. Now, pause here for just a moment. The reason why I put this in about the earnest money is it's important that from start to finish, if your 401k is who is purchasing the property, all of the money going into the deal comes from the 401k. The property and the purchase agreement are titled in the name of Jones Investment Trust. And at closing, David signs the purchase agreement as the 401k trustee. David then sends the wire for the rest of the funds to the title company from Jones Investment Trust, his solo 401k trust bank account, to complete the purchase. And as the rent checks begin to come in, the funds are deposited right into Jones Investment Trust. That's David's solo 401k trust bank account. When property taxes are due, David pays those property taxes from the solo 401k trust bank account. And if any expenses or repairs are required, those are paid from the solo 401k bank account as well. If David ever sells the property, Jones Investment Trust is listed as the seller. The title company, or maybe the attorney, will send the net proceed funds directly to Jones Investment Trust's bank account. There's no 1031 exchange that's needed, and David can sell the property and put the profits right back into the solo 401k and move on to the next deal.
Right. And one thing let's make a point of is, David's smart in this scenario where he's still got a lot of his cash in the solo 401k sitting there in cash, because this is everything related: income, expenses, profits. It's all going in and out of the solo 401k bank account, including any needs for repairs and maintenance. You always want to budget for reasonable repairs and maintenance, and then keep even more cash on hand, because if something goes wrong and you need a more expensive than budgeted repair, you cannot pay for that with your personal funds. So David's here looking at his basic, bottom line. The stats on his deal is looking at that $712 a month of positive cash flow, and his projected, conservatively, pro forma 5-year annualized return of 8.78. Let's check in on questions here about the cash deal. If you have any questions, type it under question, and when we get those answered, we'll move on to the second of the 5 ways. Any other comments from you, Rachel, of what we need to share on the cash deals?
I think that you covered a lot of it. It's just, as I mentioned, really important from start to finish, from top to bottom with that deal, to use just those 401k funds.
Yes, absolutely. That's a core rule that you want to follow. Another thing we want to point out here is that David doesn't have to go through any intermediaries to do this deal. He actually does the deal himself directly, just like he would if he was doing it in his personal name or in the name of an LLC that he owns. Here, it's just the trust as the entity that's being used. So this is the benefit of using a checkbook control retirement plan. There's no custodian that might take 2 or 3 weeks to process the deal, or get in there and mess up the funds transfer or anything like that. Trusted intermediaries are important when they add value, but when you can go in and do something faster and without any friction, then that's where the checkbook control retirement plan can help. Okay, we have a question from Bob. If a renter of my 401k, my 401k owned property, pays a monthly rent directly to me rather than my 401k, can I just deposit the rent into my 401k bank account? Well, if he makes a check out to you and then you deposited that into the 401k, you technically would probably be okay because it's not you that did anything with the money. You never had the money. But the best solution, of course, would be to get that payment submitted correctly. So if it's just a check, you'd probably be okay endorsing it over to your 401k trust. Personally, what I would do is I would give the check back and say, oh, you know what? You didn't follow the instructions to make it out to this trust. And in reality, we'll talk about this a little bit later, but a lot of solo 401k owners already have a property manager in there to manage the property so they can be sailing around the world or traveling or just having the peace of mind of knowing it's managed, and they'll make sure that it's made out to the right person. Of course, the tenant is never going to have the ability to stick money in your personal bank account because you should never give them the instructions to do so. So as long as your instructions are in there, you probably won't run into this, but if you do, it's an easy remedy. Thanks, Bob. All right, is the trust at the bank owned by who? My Social Security or some IRS trust number? This comes from A. Gibson. Okay, thanks, A. Gibson. So when you create your solo 401k plan, or when we create it for you, the plan is really just a set of documents. Kind of like just imagine a document sitting there on the table. It's just a document. But what that document package does is it creates an entity. And an entity is kind of like a fictitious or an imaginary person. And that's what a trust is. So your solo 401k trust is really created by those documents, and you are the trustee. The beneficiary of it is whoever you designate. So that's who it will go to upon your passing. But the owner is you. You're the owner. This is your money, just like any IRA or any other retirement account. You're simply exercising control directly at that trust level. So the trust has its own tax ID number that we obtain for you from the IRS. And that tax ID number is specially coded in the IRS computers to know that this is a qualified retirement trust.
And I want to just make a little item of clarification here for you, A. Gibson, that the bank is not opening a trust. You have a trust, a 401k trust, and you open a bank account for that trust, and you can do that anywhere.
Right. So as I said, that the documents form the trust. You're the owner of that trust. You're the trustee, person who controls the trust. The beneficiaries are whoever you designate. And then when you go to the bank, it's just a bank account. So every bank account has an owner. If you have a personal checking account, the owner is you as a person. If you have a checking account in the name of an LLC that you formed, like as a business, then you just have a bank account and the owner is in the name of the LLC. Here, it's just a bank account. It's just a checking account. This is an item of common confusion, and that's the reason why we always encourage people to use our recommended banks who don't get confused. Okay, Rami, we're going to hold yours for a little bit later, and same thing with Tom. We've got both of your questions. We're going to move on to the next because your questions, I think, apply to all these different ways, and we'll continue on to the second method of using your solo 401k to buy real estate.
And that is buying property using financing. Buying a property using financing means you'll get a mortgage. Typically, this mortgage loan will come from a bank or a private party. And remember, anytime a solo 401k gets a mortgage, it must be a non-recourse loan. There are some special considerations for a non-recourse loan, and we'll cover those in just a moment. First, let's look at an example deal of buying a property using financing. Claire lives in California, but wants to buy a property in Texas with her solo 401k funds, where properties tend to be more affordable. Claire currently has about $200,000 in Joyful Retirement Trust, her solo 401k, And she's identified a property in Dallas worth $150,000. She doesn't want to use the majority of her solo 401k funds in one deal, so she decides to explore getting a mortgage on the property.
And by the way, back to A. Gibson's question, in Claire's case, this Joyful Retirement Trust, that's the name of the trust that she has selected. And she can name it just about anything that she wants. It just needs the word trust in the name. And that's something that she does when she set up the plan with us. So then she looks at the numbers, and here's how they look. So she is looking at this $150,000 property. That's the purchase price. $90,000 down payment. So with a non-recourse loan, you need to put a bigger down payment because you're not guaranteeing the loan. So the lender or the bank is securing only by the property. They want a bigger down payment. So the down payment is $90,000. The non-recourse loan is $60,000, and there's a 6% interest rate. It's a 20-year term on the mortgage, and the mortgage payment is $429. So the way that monthly it looks, you got $1,700 in rental income. You've got expenses of about $1,125. This yields a net operating income of $12,048. You have this $429 mortgage payment. So there's a cash on cash return of 7.53%. Claire, just like David before, makes a really conservative projection in her pro forma numbers to assume a 2.75% appreciation rate per year. And that makes her 5-year annualized return 10.8%. Not bad.
Now, you can't sign a personal guarantee on a property owned by your retirement account, as that would be a prohibited transaction. And the loan requirements are a bit different when a retirement account is the buyer. Let's cover some fast facts about non-recourse loans. So no personal guarantee, as we just mentioned, which also means there's no credit checks and no income statements for you personally. That's because you're not being underwritten as far as the ability to pay. What's happening is the bank or private party issuing the non-recourse loan is going to be underwriting the property itself. Typically, this means that 40 to 50% is required to be put down because the risk is higher for the lender, and sometimes the interest rates are higher too. In the case of a default, if you stop paying those mortgage payments, the only recourse is for the lender to foreclose on the property.
Right. So the lender or the bank in this case is really looking at the property. What do we really think it's worth? And most importantly, they're looking at the potential rental income of the property too. And that's why they want that big down payment, is they want the mortgage payment to be so small that in every conceivable scenario, the rent is going to be able to come in and cover the mortgage payment. So there's almost no chance that you would ever default and that they would ever have to foreclose on the property. But if they do foreclose, if they ever did, they want to know, hey, you put 40% down, so the property should be worth more than what they're owed if they did need to foreclose.
As the trustee for Joyful Retirement Trust, Claire signs the non-recourse loan paperwork where her 401k trust receives the mortgage. At closing, Claire sends, I need to update my numbers, $90,000 from Joyful Retirement Trust's bank account to the title company and signs the purchase agreement as the trustee. The purchase agreement for the property is in the name of Joyful Retirement Trust, and the bank sends the rest of the funds to complete the transaction.
Right. So on the buyer line of the contract and all of the paperwork, the buyer is Joyful Retirement Trust. And on any documents, the signature is for Claire signing as trustee of Joyful Retirement Trust. So the numbers again are that $1,700 a month of pro forma income, projecting $1,125 in expenses, including budgets for maintenance, repairs, capital expenditures, and ultimately leading to a conservatively projected 5-year annualized return of 10.8%. Of course, if the property increased in value by a lot more than 2.75% per year, Claire might see annualized returns in the realm of 12, 15, 18%, or even higher. So she has that upside there in the marketplace. And in this case, because she used some leverage, that leverage means that any more appreciation above and beyond her projections, she's actually keeping the lion's share of because the bank's money was used and the bank doesn't get any of that appreciation.
So let's cover a little bit of rental property best practices here. As Jeff mentioned earlier, it's a really good idea to hire a third-party property manager. We don't recommend that you manage a property owned by your own 401k. If you do, there's a couple rules to follow. You may not pay yourself or receive any compensation for managing the property. And if you are managing a property owned by your 401k, you are not the landlord.
Well, you might be the landlord in the way that you would collect rents, what the IRS considers ministerial duties, but you're not the repairman.
Right.
So you want to always hire out repairs, maintenance. And the reason for that is because those repairs and maintenance technically would be considered contributing value into your 401k, and all contributions into your 401k need to be made in dollars, not in sweat equity. Similarly, anyone who's related to you, family members, you really don't want to hire out to them because they're what the IRS calls a disqualified person, and your 401k trust really shouldn't be doing any business or hiring them for any reason. And it's also a good idea if you're the realtor or if you're a realtor to not be the realtor, or if you are the realtor to not take compensation. So
no commissions if
right.
your 401k buys a property.
Yeah, the whole idea here is the IRS wants to know that when you're doing the deal, that there's not a conflict of interest where, maybe you're doing the deal because you really need some money personally, and so you're just generating a real estate commission for yourself, right? So if that were a motive, the way the rules are written, Congress didn't want the IRS to be the arbiter of how much that motive interfered and how much that conflict of interest played in. Were you really conflicted or only a little conflicted? Are we going to really come get some money from you or sort of get some money from you? Right? They don't want that gray area with muddy waters. So they just say, they really don't want any conflict of interest. So best practices, you just want to maintain an arm's length transaction for your solo 401k investments. When your solo 401k is writing a check or hiring someone, then it shouldn't be you or your relatives. And if your 401k funds are in your deal, then you and your family members should not be. Okay, so let's move on to number 3, investing in a real estate fund.
And we have a couple different ways that we're going to talk about investing in a real estate fund. The first is going to be investing in a syndication. Sometimes when there's a larger property, like an apartment complex, an investment sponsor will raise capital, that means they're raising money, in a syndication deal. Typically, this means several investors purchase membership shares in an LLC, and that LLC then gets a loan to purchase a property. These deals might be apartment complexes that are worth a few million, where a single investor might not have otherwise had the capital to make the deal happen. And in a syndication, there's often 2 parties involved. There's a general partner, also known as the GP. This is the party who puts together the deal, raises capital, secures any remaining financing, hires and manages a rehab team, and sells the property if the syndication has an exit as a part of the plan.
Yeah, I would say there are 2 types of participants. One is the general partner, and there's only one general partner, whether it's an individual person or an entity managed by that person. That's the syndicator. And then the other role is the limited partners. And the reason why these syndications are done is to give limited partners the ability to chip in and pool funds. So they're usually multiple limited partners. These are passive investors. The LP's role is just to give the money, just to invest the money and let the GP do the active work, making the deal profitable while the LP is passive.
In putting together a syndication, the general partner will often look at the area where they're thinking of investing to see what kind of returns are possible. They'll often choose apartment complexes where the rents are undervalued or where they believe that they can raise the rents a bit. And the way syndicators bring returns for their investors is to purchase a property, fix it up, and raise the rents.
right? So sometimes it's because it's undervalued. Other times it's because maybe the apartment's been neglected.
Yeah.
And with a little bit of a facelift, maybe $1 goes into for every dollar that goes into the facelift, making a new facade, improving the roof,
repainting,
maybe adding some amenities
Mm-hmm.
and bringing it up to a higher level rental where it'll command higher level rent. A lot of times for every dollar that goes into that work, they might get $1.50 out. And then on top of that, they're leveraging through the financing.
Right.
That can sometimes be, a bit of a good amount of leverage, maybe only 15% down is paid by the entity. And then the syndicators will maybe hold the property for cash flow or raise the rents, let them stabilize, let them what's called season the higher rental income, and then plan an exit for as little as 2 years later, oftentimes 3 or 5 years later. And there's higher cash flow in the meantime, but with the leverage and with that so-called forced appreciation, the total annualized return on investment after the exit can be really nice. Sometimes it can be 15, 20, 25%, and that's hard to beat.
Mm-hmm.
So let's go through the case study.
Yeah. So Rama is raising capital for his apartment syndication. Rama's the GP. His friend Aziz has a solo 401k and wants to invest in Rama's deal. The investment amount is $100,000, and let's take a look at the numbers. Rama is looking to raise $1.5 million total. That means he needs 15 investors at $100,000 each. He's looking for total funding of $3.5 million, and this includes the purchase and the rehab for the property. There's projected returns of 115% in 5 years. That includes an exit, which is about also 10.2% annualized. That's their dividends and distributions. So the investor, the limited partner, can hope to recoup the original $100,000 plus the $51,000 in dividends during that 5-year holding period.
So as a solo 401k trustee, Aziz completes the subscription documents for the syndication using his trust name, Kapoor Investments Trust. And that trust is the investor. All the paperwork is in the name of that trust. And Aziz signs the paperwork. And the funds for the investment, of course, come from Kapoor Investments Trust, which is a wire from the bank account or a check. As quarterly distributions are paid out, the funds go right back into that bank account. 5 years later, the syndication has an exit and the apartment complex is sold at a profit. That profit goes right back into the 401k trust bank account with no taxation. Let's make a point here that we should have made in method number 2.
Okay.
When leverage is used, a solo 401k does not have to pay a special kind of tax called UDFI that a self-directed IRA otherwise would have. And this is not a loophole. It's hard-coded into the law. So back when we talked about Claire, if Claire sells the property or her cash flow, that same deal held in the name of an IRA or an IRA LLC, it would incur a small tax. And it's not cost prohibitive, but it is a tax. It is a drag on the return, and it does require accounting fees to file what's called the 990T form. The solo 401k just gets to skip all of that because it's literally exempt. Same thing here in this syndication. If there's leverage used, there's a good chance that the CPA will tell you we need to pay taxes for your IRA if the investment was made with the IRA. But because Aziz made it with his 401k trust, a 401k is in a different tax category known as a qualified plan, right? So 401, that's the tax code section that it's governed by. The tax code section IRAs are governed by is 408. Because 401s are not 408s, the IRAs pay a tax, the 401ks don't. It's a special benefit. And when you can get some of these higher returns from higher leverage, particularly in a syndication, that's when the 401k tax exempt benefits really shine. So there's no capital gains on the profits. And also, in order to have this benefit of fully deferring taxes, you don't need a 1031 exchange. You don't have to roll that money into another property within any time period. You could take that money and put it all into gold. You could take that money, the proceeds, Aziz could put it right into Bitcoin. He could just leave it in cash. He could go back into stocks. This is really the kind of freedom that you want as an investor. As an investor, the more chaotic things are, like in the current financial crisis, the more you don't want rules telling you what you have to invest in when, because it might be unfavorable market timing. You want to choose investments that you feel have favorable market timing. And sometimes that means getting out of one asset class and getting in another. So that's what I love about not depending on a 1031 exchange. You can cross over asset classes. And even if you stay within the same asset class, there's no restrictions on exactly what kind of property you need to get into or the time frame that you need to get into it. All right, so best practices, Rachel.
If you're a general partner or a GP on a syndication, your solo 401k cannot be a limited partner on the same deal. In other words, remember we talked about Rama was the GP on that deal. If Rama has a solo 401k, his solo 401k can't be an LP where he is also a GP. Your solo 401k
it can't be an LP in the deal,
right? In the same
for
deal.
which he is the GP.
Exactly. Your solo 401k can be an LP on other people's deals, but not your deal.
Exactly. So let's pause here and just check in on questions because I do see they're rolling in. We have one from Rami and Tom that we'll get to. Any lender you recommend for the solo 401k investments? We do have a couple of lenders. You have Solera Bank out of Colorado that we can make an introduction to you. You have Titan Bank out of Texas that we can make an introduction to you. And there's also North American Savings Bank. We also have our next webinar in this series coming up is going to be literally on non-recourse financing. So good on you being registered for this series. And coming up in the next webinar will be all about those lenders, diving into that a little bit further. All right, so thanks for that question, Rami. Okay, so Shankar asks, with the down payment at a minimum of 40% and the interest rate at a minimum of 5.5%, the returns typically get wiped out and cash on cash is usually very negative. I'm thinking of $1,700 rent on a $150,000 property is not practical. My challenge has been to make a rental property work in these numbers where I at least break even. How would you advise on this? Yeah, great question, Shankar. So this is really a matter of timing and market, right? So there is the real estate market. It's just an abstract concept. You can't go touch the real estate market. There are really numerous real estate markets, plural, right? So depending on your strategy, like the strategy that might work in coastal California is probably very different than the strategy that works well in Ohio or Oklahoma. So it's really going to depend on where you're looking. Some areas don't really appreciate much, but they have strong cash flow. Other areas appreciate a lot, but they have weak cash flow. And it's kind of a deal by deal thing that you want to analyze. By the way, if you have a certain approach and when you go out there in the market and you look and you try to use that approach and you can't go to any place and find the numbers to work, then that means the market is overheated and you might want to wait for it to cool off for your strategy to work. There's a lot of institutional investors out there who, for example, do all sorts of real estate strategies. I just met with some in Los Angeles last year, and this was before the crisis even really kicked off. And they have this one guy in particular, multi-billion-dollar investor. He's got a formula, just like you're talking about, Shankar. And when his formula spits out the result of do this deal, he always does the deal. When the formula spits out don't do this deal, he never does the deal. And as of last year, the markets were heated up so much in LA that his formula would not allow him to buy deals. So he wasn't investing in real estate any further at that point. He already had plenty of other real estate investments. So that's just one of those.
That's a good way to emotionally detach from it too, isn't it?
Yeah,
just
exactly.
Let the numbers really, really drive it for you.
Yeah, Shankar, you said my challenge has been this. that might be a challenge. It also just might be a sign that with that approach, there's no deals to be made right now. So this is one of the reasons we're doing this webinar is you can look at different kinds of deals. Shankar also asks, does this non-recourse loan approval depend on my DTI? Yes, now you're hitting it, right? The debt to income ratio or your debt service coverage ratio. These are the things that the lender is going to be looking at because they're not going, is Shankar a stand-up citizen that's going to be paying this? No, they're looking at, is this deal capable of servicing itself?
They don't really care about you. They just care about the property.
They do, right? If Jeffrey Epstein's Ghislaine or whatever her name is, if she went in for a non-recourse loan right now,
she'd probably get denied.
I'd gotta imagine that she would be denied. But if you're a normal person and when somebody Googles you, it's not a picture of you for your numerous felonies or anything like that. If you're not an alleged pedophile being talked about by millions of people, I think that lenders always, there's the 5 C's of lending. One of them is character. They're always going to think about character, but they're not going to ask you to sign a personal guarantee. That's what a non-recourse loan is. So yeah, it will depend almost exclusively on things like if you're talking about DTI personally, no, that's not what they're looking at. If you're talking about the equivalent of DTI in the real estate world, it would be debt service coverage ratio, where they're wanting to think about the property as its own person. So for example, let's say your 401k trust has other properties. Well, your 401k trust is not providing a personal guarantee either. So they're not going to look at the debt to income ratio of the trust as an overall entity or fictitious person. They're only going to look at the debt service coverage ratio of the property itself because the property is the only collateral. Thanks, Shankar. Okay, what are the consequences of a 401k being named XYZ 401k plan versus XYZ 401k trust? Yeah, good question, Bob. Well, you actually set up both a plan and a trust. So every solo 401k has 2 names. There's the name of the plan. That's just an internal document thing. And then there's the name of the trust. That's the entity that's getting the tax ID number and holding the assets. So the name of the trust can technically be anything, but in order to avoid confusion, it's ideal that the name of the trust includes the word trust to help distinguish that. All right, we're going to pause on questions. We do have some more queued up in here. We're going to continue, and we'll get to those here in the next section. The third, another way of the third way, so this is 3B.
Yeah, 3B. 3A was syndications. 3B is a REIT.
REIT, real estate investment trust.
A REIT is a real estate investment trust, and this is a structure where a company purchases, owns, and operates income-producing properties. REITs can be made up of multiple types of properties, including apartments, hospitals, single-family homes, hotels, senior living facilities, etc.
Right, and some REITs will focus on a specialty and maybe hone in on just one of those categories, like maybe only student housing or only senior living facilities or buying tax auction properties.
There's a few different types of REITs. There's equity, or sometimes known as income REITs. These typically buy and hold income producing assets. Then there are mortgage or debt, or sometimes called growth REITs. These typically hold mortgages on properties. And you'll have sometimes hybrid REITs, which can hold both properties and mortgages.
So let's get into our case study for 3B, investing in a REIT with your solo 401k. Denise has a solo 401k. She's identified a REIT that is made up of tax auction properties. The returns look good. Denise does her due diligence, decides to invest. So her solo 401k is going to be a shareholder in the corporation that created the REIT. The buy-in is only $25,000. Denise feels comfortable with the risk versus the reward after completing her due diligence. So Her solo 401k's trust is called DBT Trust. Denise completes the subscription agreement with the investor listed as DBT Trust and her signing as trustee. When Denise is asked to input a tax ID number, she inputs the 401k trust EIN, or employee identification number, for DBT Trust. An EIN is kind of like a social security number for a fictitious person or an entity. So a trust is like an entity, and it has its own EIN. Denise set up the solo 401k with us, and we assigned the EIN to her. So she looked in her document package she got from us, and there it is, the EIN letter. So she uses that with her documents. She signs the subscription agreement for the REIT, and DBT Trust is the investor.
When Denise is ready to invest, she wires the funds to the investment sponsor from DBT Trust bank account, and distributions for this particular REIT are sent quarterly to her solo 401k trust bank account, so Denise never personally handles the funds, and this avoids any taxable distribution.
So benefits here, similar as with a syndication, right? So it's totally passive. Denise doesn't need to do anything. She's just a money gal, right? Somebody else does the work to identify the market of where to invest. Somebody else does the work to find the properties, acquire the properties, rehab or improve the properties as needed, deal with property managers or self-manage. They're all doing that at the REIT level. And Denise's solo 401k gets to capture the rewards of other people's efforts, a really useful type of leverage. So Denise plays a completely passive role, just needs to sit back and receive the dividends from her investment, which of course go right back in to her solo 401k, which is to say deposited into the bank account in the name of DBT Trust.
And I know sometimes this can sound like a broken record, guys, like back into the 401k bank account, back into the 401k bank account. But we say that for a reason, because I would say at least every month someone goes, can I just put the rent in my personal bank account? So it's important that we do sound a little bit like a broken record on that.
Yeah, for some reason, it seems like our webinar attendees actually watch other videos and read other publications that are not about solo 401ks.
Boo hiss.
I know. So we have to do a little bit of repetition. So 3C is investing in crowdfunding. Crowdfunding is a way to source investment capital from multiple people. These people typically don't. So again, pooling funds together, right? So you can pool your funds with other people without needing to know them or even know who they are. So crowdfunding usually happens through a centralized portal, usually on the web or in an app. And sometimes crowdfunding deals are also themselves structured as REITs. The Jobs Act was passed in 2016. We provided a lot of news coverage around that leading up to it and the significance of it. And thankfully, there's been a lot of action in the area. There are many providers. You'll see some icons there on the right: Fundrise, Farm Together, Equity Multiple, Fund That Flip, Yield Street, Senior Living Fund, Rich Uncles, and many more. So you can choose the investment based on your goals, do your due diligence, and see what the requirements are. Sometimes you need to meet a certain net worth or income requirement. Other times you really don't. Sometimes the minimum investment can be, $100,000. Sometimes the minimum investment can be $5,000. So there's a really interesting marketplace developing out there in crowdfunding.
And I'm glad that you brought that up, Jeff, because when you were talking about sometimes there are certain net worth or income requirements, specifically what a lot of crowdfunding sites might ask is if you are an accredited investor. And an accredited investor is someone who has a total net worth of at least $1 million, not counting your primary residence.
Alternatively, if you make $200,000 per year in net earnings yourself, or $300,000 per year in net earnings combined with your spouse, then you are also an accredited investor. So those are two ways you can qualify.
And an important item of distinction here, because if you want your solo 401k to invest in crowdfunding and it's for accredited investors only, the solo 401k does not have to have $1 million.
No, it's you as the owner of the solo 401k, and the solo 401k contributes towards your $1 million net worth, not counting your primary residence. So as long as you're an accredited investor, then you can use your solo 401k as a vehicle to invest. So let's get into the story. Jonas is an accredited investor because of his earnings. He's an entrepreneur. His business does very well. He typically makes about $350,000 per year. Jonas then plans to max out his solo 401k, which he just recently set up with us, by making contributions every year and aggressively building his retirement nest egg. But he's early on that journey. So far, he only has about $20,000 in his solo 401k because he's only had it for a few months. But he's a high earner. He's confident he's going to keep earning this high level of income and keep contributing to his solo 401k. But he doesn't want to wait for that $20,000 to add up to, putting his own deal together. He wants to leverage other people's efforts, and he wants to go ahead and deploy the $20,000. He's an accredited investor because of his annual income, and he decides to invest funds into Fundrise, one of the crowdfunding real estate platforms. He goes to fundrise.com and opens an account for his solo 401k, which is the trust is called Magic Trust. We notice people tend to get creative with their trust names. So Jonas wires $5,000 from Magic Trust, the bank account, and over to the Fundrise platform. He just points and clicks. It's really easy. And then the dividends begin to pay out in the very next quarter. Those dividends can be either automatically reinvested so that his investment is compounding, which is what Jonas wants and what he chose, or he can select with Fundrise to have the dividends sent right into his bank account, and he'll just get a little text message saying your dividends were sent or your dividends were reinvested, depending on what he chose.
With syndications, REITs, and crowdfunding, you're leveraging other people's efforts in your investment. This means you can sit back and receive the dividends or payouts while somebody else does the work to find, manage, rehab, and potentially liquidate that asset. Because syndications, REITs, and crowdfunding are pooled vehicles, this also means you can put in less money and get access to deals you might otherwise not have had.
Right. And in the case of Jonas, he's got kind of the full spectrum of crowdfunding to choose from because he is an accredited investor.
Right.
For anyone who's not an accredited investor yet, that means you might not have the full spectrum, but there are still options out there. All right. So if your solo 401k doesn't have enough capital to buy a hospital, then maybe it can participate in a real estate fund of one sort or another, where you just put a smaller amount of money to be one among many partners or investors in a fund that invests in a hospital. Because you're handing your money over to someone else to get the results and provide the active management activity, then you always want to do your due diligence on whichever fund or group you're investing with. Okay, so let's just check in and see if there's any questions that are about what we've covered so far. Okay, let's just cover some of these. So if I'm interested, this is from Ken R. If I'm interested in syndication, where do I locate syndicators to partner with? This is a great question. We're actually creating a network and a marketplace that you're going to get access to very soon in August, potentially even sooner. As a valued webinar attendee, you might be getting an email next week. You might want to pay attention to your emails next week from us. And this is a common request is, there's all these different kinds of, vendors that are out there. Where do I find the bank accounts? Where do I find the lenders? Where do I find the syndicators? We're going to continue doing these webinars. We're going to have future webinars with syndicators. And we're also going to be opening up this marketplace very soon where you can check some of them out. You'll always want to do your own due diligence. We're not going to do your due diligence for you, but we'll help connect you with syndicators worth considering. All right. What financial software would you use for real estate in a 401k? It's coming from Jim. Jim, maybe you can ask a clarifying question here on exactly what you mean by the software. Do you mean like accounting and bookkeeping software? If so, write that, or if not, clarify it in a new question. Thanks. Jim also asked, how do you value real estate for the 5500T in a 401k? Well, There are various forms of 5500. The normal 5500 is quite expansive and a pain. It requires a lot of hours to fill out. Okay, luckily, so there's several titles to ERISA. ERISA is the retirement plan law that was passed in the 70s. Some of those titles create all of the pain out there in compliance. And, there's a lot, a normal 401k with thousands of participants is probably going to cost hundreds of thousands of dollars a year to run. This one only costs, a few hundred or less, right? So part of that is because the real onerous regulations are in the titles that don't apply to your solo 401k. With a solo 401k, it's just you. There's not going to be a whole bunch of other people depending on you as other participants, just you, or maybe you and your spouse. For that reason, what you need to fill out is a 5500-EZ. And this is one of those times where EZ really means easy. So your 5500 EZ is only a couple pages. It's very easy to fill out. And when you log into your account at solo401k.com, we have a 5500 EZ generator. And you just fill out, answer a couple of questions. And in the amount of time that it took for you to write this question in the webinar, you would probably fill out your own 5500 EZ. You could then file that if you like to self-file, or you can hand it over to your CPA to double check, and they could file it for you.
And Jim, what you might be asking is, okay, so I've got a property in my 401k. How do I value that so I know what my total plan value is for on the 5500 EZ?
Yeah, I missed the mark there. You're right.
Yeah.
You're hitting the nail on the head.
I got you, Jim.
Yeah, that's why there's two of us here. Between the two of us, we understand what one of you mean. All right. So the best way there is to sort of create a level playing field where one government agency kind of, logically has to respect the determinations of another government agency. So what we're getting at here is that real estate, you kind of have an automatic valuation every year in the form of a tax appraisal. So what a lot of people do and what a lot of attorneys recommend is just to use the value on the tax appraisal. Now, remember, with a solo 401k, there's no UDFI. There's no income tax being owed on any of the activity, the gains or the income. So the purpose of the 5500-EZ is 99% of the time not going to influence taxes one way or another. So it's really just more for census-like keeping tabs on how much money is out there in retirement accounts. So this is something that the IRS, I've never seen any evidence of them scrutinizing. So it's not a good idea to just, pick a number out of the air. You want to use something. And that's where the tax appraisal for any property is automatically done is the best bet for like way number 1 and number 2, where you're directly owning it. If it's way number 3, then you're getting valuations from your fund or your REIT or your crowdfunding platform every year anyways. Okay, Hunter says, I'm thinking of being a GP for a syndication to do a large project. Wouldn't I need to involve the SEC, registering or something? Yeah, Hunter, that is definitely something to check in and do some research on. One way that we could help you is if you're doing a syndication and you want to do a joint webinar where we can educate your audience about how they can use their solo 401k, that's where we can help. If you are looking to just kind of get started on your research of how to do your own syndication, I would suggest to just type that into Google as a starting point, and I think there are a lot of great resources out there. Thanks, Hunter. Okay, we're going to get back to, we do have still a queue of questions. We're aware of it. We'll be back in question mode in a moment. But for now, we're moving on to method number 4, investing in mortgage notes.
There's multiple types of mortgage notes and promissory notes that are available. Some of them are secured, which means they're backed by a property. That's a mortgage note. Some of them are unsecured. That's where it can sometimes be harder to get your money back if the borrower doesn't repay. With a secured note, if the borrower fails to repay, you can often foreclose on the property that's listed in the note. And that foreclosed property then becomes part of your investment portfolio. So an example for this is when Tim came to us, he was a longtime note investor with his self-directed IRA. He set up his solo 401k so he can continue investing in notes without any custodial delays or extra fees. And Tim likes various types of mortgage and promissory notes in the real estate space, and we'll look at an example of a note deal that he did. He wants his solo 401k trust, which he named Flippin' Great Trust, to lend funds to a property flipper.
Flippin' great name.
Flippin' great name, right?
Although I don't know if he needs the G on flippin'.
Yeah. It could be like flippin' with like an apostrophe at the end.
Mm-hmm.
Yeah.
Yeah, we should email him about
Yeah,
that.
we will. Okay. These are all fictitious people, by the way, just so you know. None of these are.
Well, they're all based on real
They're
people.
all based on real
but
clients, but we would never use their real
names.
names.
But the names are changed to protect the smart.
Exactly. But if you are on this webinar and you don't have a solo 401k yet, and you're considering joining us, then hey, these are also name freebies for you to consider for your own 401k that you might set up. So the terms of the deal are that Flippin' Great Trust will lend $100,000 to the flipper with the principal and $10,000 of interest due in 6 months. There are no monthly payments on the loan. Very straightforward. Tim has his attorney write the promissory note secured by the property that the flipper is working on. And Flippin' Great Trust is the lender. The flipper is the borrower. As the solo 401k trustee, Tim wires funds to the flipper from the solo 401k trust bank account for Flippin' Great Trust. At the end of the 6-month term, the borrower sends $110,000 back to Flippin' Great Trust bank account. In the case of a default, Tim may begin foreclosure proceedings on the flipper's property, where the solo 401k trust will become the owner of the property listed in the note. So as a quick recap on this particular deal, promissory note is written for $100,000, and the loan terms are to repay the principal plus $10,000 of interest in 6 months. So this gives a projected return of 10% in 6 months. You know, if Tim does this just a few times, this can be a really killer return.
Absolutely. Yes, exactly. And yeah, let's just keep on moving on,
let's roll
we
on
do have
through.
some questions here that kind of run the gamut. So method number 5 is you can actually use a participant loan to fund your down payment or investment on a property that you then buy outside of your solo 401k. Now, this is a way to use 401k funds to do an investment that is not going to be in your 401k, but it's outside of your 401k. So the participant loan is a great way to do this kind of deal, particularly if there's something involved in the deal that would otherwise be a problem. So for example, let's say you want to invest in a syndication, but your wife is the syndicator, your spouse or your mom or your son or a family member. Remember earlier, we know you don't want to be writing checks and signing contracts as the 401k trustee with family members on the other side of the transaction. So if there's a deal that's so sweet you don't want to pass it up, but it does involve a disqualified person, then when you take a participant loan out of your 401k, that becomes not 401k money.
Right.
Now the 401k has a loan out to you, which is totally legal when you use our documents that are IRS approved. And then that money becomes useful for anything. You can actually use it to pay down debt or buy an RV. We can talk about that another time. But in this case, you can also purchase an investment property, even if it doesn't involve a disqualified person. Another reason why some people use the participant loan to invest in property outside the 401k is if maybe that deal has really special tax benefits, right? If there's tax benefits, you're not going to capture those in the 401k because it has its own benefit scheme where it's called just no taxes on your growth, right? But if you have some other major tax benefits you're trying to capture, then you'll need to do that outside of your 401k. Another reason might be to do a deal that has a higher leverage or a higher loan to value mortgage rate. So, you know, like instead of looking at a 60% LTV, which would require 40% down payment, you might be looking at an 85 or a 90% LTV where you only have to put 10 or 15,000 down. And that loan that you take out can be normally up to $50,000 which is also subject to 50% of your account value limit. So you could take a max of 50,000 loan out of your 401k as long as all the assets in your 401k are worth over 100,000. But right now, because of the Coronavirus CARES Act, this temporary stimulus measure, you can take a loan out of your 401k up to 100,000, and you can even go up to $100,000 loan, even if that 100,000 is all of the money in your 401k. So the loan has to be created and funded by September
22nd. September 22nd.
Right. And the way that you do this is you log in to solo401k.com, where we have set up your 401k for you. That's your document dashboard. And you go in and you click loans up in the top, and you can create a participant loan. If you need those special provisions for the higher limits for the Coronavirus CARES Act loan, then choose that one from the top menu. And then you fill in those fields that you see right here on the slide. And you literally, as long as your name is Benjamin Button, I see you've put.
And I wanted his trust to be called Eternal Youth Trust.
Right, but there's no field for that because it already knows it.
People, you have to understand that half the fun in making up these webinars is writing trust names for people.
Right. It's almost like working at Disney over here.
It's true.
So Benjamin Button in this example goes in. You just put the loan amount, the loan term, the name. Your social security number is saved and encrypted and cryptographically hashed so that it's not going to be displayed on the web panel. And then you submit it. You can just verify your last four of your social is correct, and it will literally instantaneously create the loan package for you that would otherwise result in $5,000 or $10,000 in interest charges from an institution. And here it's going to result in 0 third-party charges because you're borrowing from yourself and paying back to yourself. All right. So once you file the loan package and sign it both as the borrower and the lender, then you actually just transfer the loan amount right out of your 401k trust's bank account into your personal account. You can write yourself a check. You can do an ACH or online transfer. Very simple.
One quick note, though. Hold on. Don't write the check to your business. The check must go to you personally.
Right, exactly.
No
so
fair money
you might
going
see
right
your,
to your business.
business listed as an administrator in various areas of the 401k document package, but this is called a participant loan. So it's not a loan to the administrator. It's not a loan to the trustee, because your business is the administrator. You're the trustee. You're the participant. It's your role as participant through which you get this loan. So make it out to your individual name and or deposit that check or do that electronic transfer or wire to a bank account in your personal name. Okay. And by the way, there's no underwriting. There's no groveling to a banker. All of the process that, that you usually associate with taking loans is not really involved here. You'll also see that when you log into your Solo 401k dashboard on the right side, you'll see the loan calculator showing you your loan amount and your loan term in years, and it will calculate your payment for you. The interest rate for this payment is 1% over prime. So that currently means a 4.25% interest rate. As you can see from the example here, you've got a $50,000 loan at 5 years, yields a monthly repayment of $926. And that's a monthly payment for 60 months. Okay, now once you cash the participant loan, you can then go use that money for whatever, or in our example, to go out and do your deal where you have, by the way, the reason you have that higher LTV that we talked about in this example is that it is a recourse loan. You can sign the personal guarantee that gets the bank to lend maybe 85 or 90%, and now it's a little bit more aggressive leverage. So let's recap. There's many ways to take advantage of different types of real estate deals in your 401k. So hopefully these case studies and this presentation has been helpful in learning how you can include or continue to include the asset class of real estate and all the ways right there in your Solo 401k portfolio. So let's reopen for questions, and we'll turn the cameras back on. All right. There we go. I'm going to close the slides. Okay. Welcome back to seeing us. All right. So the oldest question was from Rami. Can I lend money personally to myself from my Solo 401k fund? All right. Great question. And the last part we just covered, the participant loan, is the answer. Now, it's not technically categorized as an investment of the 401k, but it's more a feature, a special feature that IRAs don't have, that only 401ks have. And by the way, just because 401ks can have them, most don't.
It's true.
Right? Because when you go and open your 401k at some other employer or some other institution, there's really no money in letting the money go back out the door and in your hands. So really the solo 401k is one of the few places where you can set up a plan and get that participant loan done. Thanks, Rami. Tom says, if there's a legal dispute regarding a rental property owned by my 401k trust and it incurs a judgment, is the entire asset base of the 401k trust exposed? This is a great question. So this is going to depend on the judge. It's going to depend on the jurisdiction, and it's going to depend on the legal case precedents and or the protections that of the intersection of federal law and state law. So in other words, it's all part of the process of a legal battle. But what our attorneys have told us is that ERISA plans, including your solo 401k, are among the most highly protected structures in the United States. In other words, when a judge sees this complaint, the precedence is that there's a very high level of protection where the judge sees this as, this is your retirement fund. We can't subject this retirement fund to this complaint. Now, one area where the various veils of asset protection are always pierced is fraud or malicious knowing wrongdoing. So if your tenant, told you repeatedly that the stairs were falling apart on the front deck and you just told him to buzz off repeatedly, and then a year later he broke his leg falling down the stairs that collapsed, then you might have some liability there because you didn't do a good job, as you knowingly ignored the risk, right? But generally speaking, real estate, particularly single family rentals, are pretty low liability investment to own, because in most states, the courts are going to view that the renter is responsible for being aware of the condition of the property because they have possession of it. Of course, this is a legal question and my answer isn't legal advice, but if you get legal advice, what you'll find is out of all of the various ways you can own property, a qualified plan, which is what a 401k is among, if not the highest level of asset protection that you can get. So what that means is that if you've got property number 1 and property number 2, 3, 4, 5, 6, 7, and all these other investments in your solo 401k trust, and the renter on one property went to sue you, it is very unlikely that the court would then award all these other assets to the plaintiff of that one property. All right, thanks, Tom. Johnny says, my solo 401k was set up as a sole proprietor trust, but now I have an LLC to invest in real estate. Now, how do I get the LLC with a separate EIN activities to send some of the profits as retirement contributions to your 401k to build the 401k? Okay, so this is a very common question. If your real estate dealings generate only passive income that land on, Schedule E? If the money lands on Schedule E, you can't contribute it into the solo 401k. But if you're a real estate professional and the money, the way that your CPA classifies it, if it's able to be classified as Schedule C, which is active earned self-employment income, then it can be used to contribute. So you'll always want to check with your CPA on that. Schedule C income can be used. Okay, Shankar says, for buying a rental property, if I can put in a lower 25% down payment, get a 3.5% interest rate, and claim depreciation using my personal money, when does it make sense to use a solo 401k with 40% down payment, 6% interest rate, and no depreciation and tax benefits? Yeah, great question. So one reason why you might want to use a solo 401k is because you already have a lot of pre-existing retirement money. So remember, contributions are the only way to get money in a solo 401k. You also are allowed to have unlimited free rollovers coming into your solo 401k. So if you contributed to a 401k at an employer for many years and then left that employer, or if they allow in-service rollovers, then you might have hundreds of thousands of dollars at the old 401k that can be rolled into the solo 401k. Then your question is, now what am I going to do with this, right? So when you're looking at a deal, and you can do the deal with the solo 401k or with your personal money, then you have the choice. And you'll want to just ask yourself, what are the trade-offs, and make that choice. But when you have money that needs to go to work and it's sitting in the solo 401k, then these are 5 of the ways that you can invest in real estate. Also, if you're looking at like a syndication, for example, right? So if you're just one among hundreds of investors, then there's still going to be a higher amount of leverage, more favorable interest rates, et cetera, that are able to be used. Another reason why you might want to consider doing a deal with a non-recourse loan, because you're talking about leverage here, is if your approach to the property is to simply tie it up where if the debt service can be covered by the rents, but a lot of the intended gains are going to come from appreciation, then you could do that in a Roth solo 401k. When you have a Roth solo 401k with high levels of appreciation of the assets that it holds, that can be more favorable to you than just a little bit of depreciation, right? Because a little bit of depreciation means that either you're going to always have to roll that into more and more 1031 exchanges. And what the depreciation means is you didn't eliminate the taxes, you just deferred it. And if you ever can't do a 1031, or if they ever change the laws about the 1031, or if you ever want to get that money out of the asset class, it's actually more restrictive to do the real estate deal outside of your retirement account, right? So when it comes to something where the deal is really, really sweet, the tax benefits, particularly of a Roth with a 401k, can trump the depreciation and more favorable loans.
And I think also, an even more expanded way to answer that too is, you might consider having both, Shankar. Many of our clients like to have clients that are owned by them personally or through a personal LLC, and they're in their solo 401k. So having that diversification of tax classification is great to consider in your portfolio.
Yeah, absolutely. There's not a right or wrong answer to always do it in one or the other. It's going to depend on your circumstances. And if you have existing retirement funds and you want to invest it somewhere, then just simply deploying the funds that are already in that tax-favored vehicle is an option that you have. All right. Bob says, a traditional solo 401k is subject to annual RMD withdrawal, which must come from the 401k bank account. If asset expenses deplete the bank account balance below the amount the RMD is due, what are the various ways the investor can remedy this situation? And then we have the follow-up question. Okay, so first of all, the way the numbers work out is that only happens if you make a bad investment. If you invest in property that doesn't appreciate and doesn't have a strong cash flow, and if you don't diversify, then you could have a 401k where all the money's invested in a bad investment, and then the real RMD problem is caused by making a bad investment. If you make a good investment and RMDs are coming up, you kind of want to flip it around and say, okay, RMDs are coming up, therefore I should invest in a property that has strong cash flow. If you have a property that has strong cash flow, the cash flow will always pay the RMDs, the way the numbers work out, until you're well into your 90s. And if that's going to be your strategy, then just know that you might want to sell your property at age 94 or 95, at which point you might have bigger problems in life anyways, but that should be part of the plan. So the plan should be make a good investment in the first place. That means if you have RMDs, the good investment needs to be a good producer of cash flow, and that's going to cover your RMDs well into your mid-90s in almost all scenarios. Okay, then Bob followed up from the previous question, annual valuation of 401k assets. If the 401k owner performs a self-evaluation of a trust asset, the declared value will drive the amount of RMD owed, correct? Yes, this is the reason why you want to use some sort of reasonable logic basis and some sort of external data that you can point to value the asset, right? So if your tax appraisal says your property's worth 200,000, and then you go to do your RMDs and you say it's worth 20,000, then you're basically trying
That's a problem.
Yeah, that's a problem. So don't do that. Similarly, if Zillow says the property's worth 200,000 and you say it's worth 20,000, same thing there. There's really not a hard and fast set of rules where the IRS says this is exactly how you have to do it. Of course, third-party appraisers would want you to believe that you have to pay them in their fees, just like the car salesman wants you to believe you have to leave and get this smoking deal today. Don't leave the lot without buying my car and paying me my commission, right? But simply, you just want to use a reasonable, logical thought process there with some sort of documentation. Thanks, Bob. Tom says, with respect to REITs, my concern has always been that the entity is viewed as an operating company and the income generated is then potentially considered UBTI, thus subject to UBIT. Well, if the REIT is structured as a C corporation, then there is no UBIT because UBIT is only for pass-through structured entities, right? If you have an operating company and it's structured, it's not only structured, but taxed as a partnership or any other kind of flow through entity, then you could have a concern there to take to your CPA or a tax attorney. On the other hand, if it's an LLC taxed as a C corporation, then the C corporation blocks any potential UBIT. Also, you can have your 401k invest in a single member corporation that is then used as a special purpose vehicle just to invest, and that C corporation is often called then a UBIT blocker. There's an attorney named John Heyer that we can introduce you to that can help you with that UBIT blocking if you have a deal that needs that. Hopefully that helps. Thanks, Tom.
I'll read one.
Yeah.
So isn't crowdfunding, yeah, please. Isn't crowdfunding just another name for a syndication? Or what are the differences aside from the amount of funds invested? For example, a site might have less money, whereas syndications might require more money.
Yeah, there is a lot of crossover there. Crowdfunding is a lot of the kind of up and coming deals that are crowdfunding are under Regulation A. So it's been the precedent for many years and decades that a lot of privately funded deals and syndications of all sorts use Regulation D, which usually require you to be an accredited investor. Regulation A allows crowdfunders and syndicators alike to open things up to non-accredited investors. Those are usually the Reg A's tend to be more on the crowdfunding sites. Also, in terms of terminology, syndication, might just be something that you get introduced to a syndicator and you join a webinar and you see an opportunity and you have the opportunity to invest. Crowdfunding is usually a central website and portal that provides a marketplace where you can access multiple different syndication opportunities. Thanks, Bob. Hopefully that helps. Gary, are there any advantages to crowdfunding? Yeah, I think the ones that we just covered. Crowdfunding oftentimes gets your minimum investment even lower. Syndications very commonly investment amount of 25, 50,000, 75,000, 100,000, whereas crowdfunding websites very frequently let you get in for 10,000.
I also am going to take a left turn for like 2 sentences.
Put your blinker on.
All right, I'm going to take a left turn for 2 sentences. So crowdfunding also can be things that are not just real estate. So you can have crowdfunding where you're getting into, it's like Kickstarter. Kickstarter is a crowdfunding platform. So you can crowdfund different types of investments, startups, angel investing, et cetera. That's outside of what we're covering today, but that's why the terms are not necessarily just, crowdfunding does not necessarily just mean like an apartment syndication, for example.
Excellent. All right. A no-name person with a picture. Oh, no, there it is. Stella. Hey, Stella. What options are there for crowdfunding for those who are not accredited
The
investors?
network.
Yes. So make sure that you have your best email in with us here on this webinar registration and our email update list, because we are going to be including some of those crowdfunding platforms in upcoming webinars. Also, some of the crowdfunding platforms that you may want to consider are going to have some of their CEOs and whatnot appearing in upcoming podcast episodes. And we have a podcast, if you haven't checked it out yet, on the podcast app store for Google or Apple or Spotify or any of those. It's
Self-Directed
called
Life.
Self-Directed Life. If you look at Self-Directed Life on your podcast app of your choice, subscribe to it, you're going to be hearing directly from some of the leaders of these crowdfunding platforms. And this is a very exciting space. So we'll look forward to those episodes, to future webinars, and to opening up that marketplace.
Syndications typically take a 20 to 30% cut. This is from Shankar. What's the cut or fees incurred in REITs and crowdfunding? It depends.
It's
basically,
depends on the platform. Yeah, it just depends on the deal. The deal. Yeah. So it's going to be varying deal by deal. Even on one platform, the terms of one deal are going to be different than the terms of another deal. So, check that out on a case-by-case basis for each deal. Okay, so Jim was saying, following up, financial software for tracking real estate, gold, Bitcoin, etc., for 401k money tracking. We have some software currently in beta that in our investor club, our members are using. We're not sure when it's going to be out of beta, but if you want kind of the earliest access to that sort of thing, then reach out to us and let us know you're interested in the Neighbors Group Investor Club.
And Jim is in the club. So Jim, you have access to this. We just need to get it to you.
Thank you. Yes. Okay. I was going to say, I thought he was in there. Of course, we've worked with him for years. Okay. Yeah. So stay tuned. We are releasing that software in batches so that we don't have all of our club members asking beta type questions all at once. So you'll be in one of the next couple waves here in the next couple of weeks.
Rami says, I am qualified for the coronavirus related relief safe harbor employer 401k for up to $100,000. This is the coronavirus related distribution. Am I able to transfer the money into my solo 401k account? Yes, you can. And we just taught a webinar a couple of weeks ago all about the CARES Act and these distributions. So make sure, Rami, you check out the replay. We probably emailed it to you. You can also find it on solo401k.com. If you go to the blog, we posted the replay there for you as well.
Right. And it'll be in the new marketplace and network as well, and very easy to find. Thanks, Rami.
Mm-hmm. Okay, Dolores says, when does the loan have to be repaid and at what rate?
Right. So the loan repayment on a normal participant loan, you repay it monthly, and you can choose 12, 24, 36, 48, or 60 months. In other words, 1, 2, 3, 4, or 5-year repayment term. So it's amortized. So you have a fixed monthly payment for every one of those payments. The interest rate is 1% over prime. So that's 4.25 is the interest rate. And if you do the coronavirus CARES Act type of loan, then you can do two things. You can increase the loan amount from $50,000 to potentially up to $100,000. The second thing you can do is you can check a box saying that you want to defer payments for a year. So then it becomes almost like a 6-year loan where your first year, you don't have any payments. And then you start paying on month 13, and then you go 60 months from there. Great question.
And Dale, I know that you had also commented on that. Will we have the slides available? Yes, when we send out the replay, we'll also have the slides that are in this presentation, so you guys can check those out too.
Okay, how are RMDs calculated when the solo 401k is all in property? Must I liquidate? Hey, Kimberly, great question. This kind of goes back to a question we answered earlier, which is that, number one, you don't want no cash in your solo 401k. That's because owning property comes with expenses. You don't know exactly what those expenses are if you're directly owning property, especially. So you always want cash available for repairs, for capital expenditures, and for potential RMDs. But if you use an RMD calculator, again, what you're going to see is, let's say your 401k just theoretically is completely full of property, okay? And then you're 70 and a half, and then you go, what's my RMD?
72.
Oh yeah, that's right. So you go to do your RMDs and you go, what's my RMD? It's going to be like a small amount. It's going to be a couple of percent. So you really shouldn't. So in your 401k, you shouldn't be exclusively owning properties that don't produce cash flow. Okay. Because that gets you into RMD trouble. If you have some or all of those properties producing strong cash flow, the cash flow will provide for your RMDs. You might need to liquidate, but again, in most cases, when you run the numbers, it's going to be at about age 95. So something to be aware of.
Shankar says, I have a couple of rental properties today in my personal name and plan to move them into a trust later. Later on, if I buy rental property using the solo 401k money, can that be added under that trust as well? I think, Shankar, you're probably talking about like a living trust or an asset protection trust. So the 401k, excuse me, does not go into an asset protection trust. It is a retirement plan for your small business, so it's going to be treated separately. What you might do is designate your trust as the primary beneficiary.
Okay, let's get clear here.
Okay.
So you have your 401k trust, okay? And if you have a asset protection or estate planning type of trust, then that trust, it would usually be like maybe a irrevocable living trust, for example. You can name that trust as the beneficiary of the 401k trust so that when you have passed away, you are avoiding the estate taxes. And instead of it going through your will, it's going through the estate planning trust that your estate planning attorney set up for you. So a lot of people do that. All right. That answers all the questions.
You want to ask the one that poll?
Yeah, let's get the last poll. What is your favorite type of real estate investment? Cash flow rental property, fix and flip, REITs, crowdfunding, syndications, or the buy, rehab, refinance, rent, repeat. So wait, you want to rent before you refinance it, and then you want to repeat.
Those R's, they get
Then you can also go running and rowing.
Yeah, those are a lot of R's. But then it's like you were saying before,
remembering, reinvesting. So you always want to do that BRRRRR.
Right. With about a dozen R's after it.
Okay, but seriously, we're just obviously killing time while the votes come in. All right, it's interesting. So right now, people are liking cash flow and syndications. I'm going to cast my vote. I think I have it open over here. I got to cast my vote.
I want to see what you're voting for.
You don't know what I'm voting for?
I mean, I think I do.
Well, there's no right or wrong answer here, but
also, I just want to jump in and say, I know many of you who are with us today are already solo 401k clients. You've been with us for a long time. And there's some new people here as well. I know some of our clients have invited their friends and colleagues to join us to learn a little bit more about the solo 401k, how to invest your retirement funds. If you don't have a solo 401k plan and you're considering establishing one and you want to learn a little bit more, go to our website at solo401k.com. There's tons of information there. If you want to schedule a one-on-one consultation, we're happy to discuss your personal situation, find out what might be a good course of action for you. The online application to establish your plan is right on the website as well. So make sure you go to solo401k.com, and that way you can learn more and join us. We love to do these webinars for our clients and make sure that you guys have a lot of actionable information. So using your retirement account is, dare I say it, fun. And we would love to have you join us as well.
Yeah, I mean, I don't know how controversial this is, but making money is fun.
Yeah, well, but I think a lot of people don't think using a retirement account is fun. They think that a retirement account is bland.
It's because
either 401k is awesome.
It's because either they're not making money, or they don't even know what's going on with it, or the money that they're making is from gambling and they know they're not going to get to keep it.
Yeah.
So what the solo 401k enables you to do is do what you want with your money, right? So if that means mixing a little bit of stocks with some real estate, some Bitcoin, throwing in some precious metals, great. I did on the poll, I apologize, I left out the lending. That's one way to invest in real estate. I'm going to close the poll. Looks like the cash flow rental properties have it. It's not a competition, but that was my vote. I really like cash flow rental property. I think if you're a business owner, the more successful that your business is, the more valuable your time is, and the more valuable your time is, the more that you just really like the idea of streams of income. Now, that could also be said for syndications. It could also be said
REITs,
for crowdfunding.
for sure, I think.
It could also be said for REITs, because these are all using other people's efforts. But just the kind of chugging along cash flow properties, that's what I have the most experience with personally, and that's my favorite. But obviously, there's no right or wrong answer there. So thanks for voting. We got 66% say cash flow rental property, 2 votes say fix and flip, and 16% say fix and flip, and 16% say syndication. And nobody says brr, 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 brr. Nobody says crowdfunding. Nobody says REIT. But we obviously do know from the questions and the comments that you guys are interested in crowdfunding. And if it's just a new interest, then obviously it can't immediately be a favorite. Okay, so we have the last couple of questions for today's webinar. Rami says, I'm interested to know more about the Investor Club details. We will email you some info or send us an email. You can email info@neighbors or rachel@neighbors.com.
Actually, not Rachel at Neighbors. It's info@neighbors or support@solo401k.com.
Okay, right. Just to make sure that you get the prompt response. Okay, and Gil says, I want to listen to this seminar again. Will you send an email like you did the other time? Yes, Gil, we will do that as soon as we are done. We're looking forward to that. All right. Thank you so much. Let us know in the comments to the right what you thought of the webinar, any suggestions for future topics. We're all ears, any feedback. And when we tell you that you can send your friends and family to a webinar, feel free to. There's a little, like when you're, right after you register, there's a little Twitter and I think Facebook and LinkedIn share button. Then, of course, you can just copy the link and share that with other people for our solo 401k webinars. All right. Thanks so much. And again, if you haven't opened your solo 401k, there's a link down there to learn more and open it where it says open your solo 401k. And stay tuned for the replay if you're waiting for it. Have a great day. Bye.